Hi, I'm Mark Anderson, a mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to help with your mortgage transaction. Whether it's a purchase or a refinance, you can find my number in the video description below. Please do call or text me anytime. So I'm going to start a new segment, the Tuesday Quick Tip. So for today, we're going to cover a very fundamental subject, which is the do's and don'ts involved in a mortgage transaction. And we're going to start with the do's. That's a weird word to say out loud. Number one, this is almost certainly the most important thing. I say be extremely honest. And what I mean by that is when you're going through the application, whether it's on an online form, if you're working with a lender that uses that, or whether it's over the phone or in person, I tend to prefer to do mine over the phone or in person because it allows some back and forth communication. But be extremely honest on that loan application. Answer all the questions truthfully. And also, you're going to want to volunteer any information. You know, if the loan officer doesn't ask you a question related to something about your finances, your employment, your income, your assets, etc., but it's something that you think might be relevant, volunteer that information. The loan officer's job is to help you get to the finish line and to help identify anything that might slow that down or cause any problems. So you're only going to be doing yourself a favor by bringing something that could potentially be a problem to that lender's attention during that initial conversation or at any stage in the process. If something changes, you really want to make sure to be extremely honest throughout the entire transaction. Next up, the whole process of getting your loan approved is built on the foundation of the application itself. But the application itself is no good without the supporting documents that go along with that application. So that's that laundry list of documents that you get from your lender up front, the pay stubs, the bank statements, the W-2 forms, the tax returns, etc. It's very, very important to provide all that information as quickly as you possibly can. And also, you want to be prepared to, throughout the process, there are going to be multiple stages where you may be asked for additional documentation. And it is always best practice to ensure your own customer service experience is good throughout to get that information or that documentation over to the lender very quickly. Next up, stay current on all of your monthly payments. That means no late payments on credit cards, certainly on a mortgage. Try to keep everything in order. If your stuff is not on auto pay, maybe get it on auto pay. It's very important not to miss anything. A single missed payment could impact your ability to qualify for that loan, and that's a good example of something that can kind of pop up and cause a problem because there are various checks and balances built into the process that can identify if you've made a late payment after the process has started. Next up, referenced this earlier with the number one issue of being extremely honest, but I thought it was important to spell this out specifically. Anything that changes, even if you're not certain that it's going to be a problem or if it's going to impact anything, you want to be in the habit of notifying your loan officer about anything that changes regarding your finances, regarding your employment, etc. Next up, this is something that causes, I'm going to say, more problems than anything else from getting a loan from the beginning of the process to closing, is not having a clear plan for documenting that you have the sufficient funds to qualify for the loan. So this may sound a little bit odd, and I think for somebody that's not in the lending business, this may seem a little bit strange that this is a problem. But it is the case that well before closing, in order to provide a full approval, the lender has to see the assets that are going to be used for the transaction. And not only do we need to see an account balance that shows that you have sufficient funds to qualify, we also need to know where that money came from. So keep this in mind. We are going to be looking at 2 months' worth of bank statement activity. And the first thing that I do when I look at a bank statement, after seeing the balance, of course, is I review that bank statement for any large deposits. Now, the definition of large in this case depends on the loan program that you're looking at, but a general rule of thumb, if there is a deposit over $500, the lender is possibly going to need to know where that money came from. There are acceptable sources and there are unacceptable sources. And this can be a real problem if you haven't made the plan very clear to your loan officer. Now, it is in a simple case, let's say you already have the money, there are no large deposits over the last 2 months, that's a clear-cut case. We can see up front that you have the money. But it is not uncommon for there to be, let's say, gift funds coming from family. Maybe there's a sale of property that's going to be used to shore up the asset balances enough to come to closing. Maybe you've got cash under a mattress. Cash under a mattress is a good example of an unacceptable source of funds. And we in the lending industry, I don't necessarily know that this is fair, but it's the way that it is. We're kind of expected to be a line of defense against money laundering and illicit activity of that nature. So we are actually really required to drill down and identify for this real estate transaction, where is the money coming from? So it is very important, I would say, during the loan application itself, especially if you don't already have enough assets on that day. It's very important to talk through that plan with your loan officer, because there are going to be documentation requirements associated with any new funds that are coming into the picture. So let's move on to the don'ts. So number one, and this was chosen as number one because it has come up over and over and over again, don't change jobs if you can at all avoid it. The worst thing that can possibly happen, and this has happened to me not just once, is a day or two before the closing, we will do a verification of employment and hear, Bob doesn't work here anymore. That's a huge problem, because the application is what we use to determine your approval, your eligibility. And maybe you wouldn't think it's a big deal because the new job, you're making more money. I hear that in every one of these cases when it comes up. Well, Mark, I don't know why you're worried. I'm making more money, so that should make me a better credit risk, et cetera. The problem there is we then have to fully document that new position. And if you've just got a couple days until closing, that's panic. That is not a fun thing to have to do. It can cause delays. It can cause problems. So it's best to avoid it at all, if at all possible. The name of the game, though, is, let's say you do have this amazing opportunity that comes up. The name of the game is communication with your loan officer. You are your best advocate in the transaction to ensure that you have a good customer service experience. So if there is a job change that you're looking to make, touch base with the loan officer, come up with a plan, because there are going to be documentation requirements associated with that job change. Next up, don't do anything that changes your credit report at all. And this means don't apply for any new credit. Certainly don't open any new credit. This also includes things like don't run up your credit card balances. Best practice, in my opinion, is don't use credit cards throughout the transaction. If your balances go up beyond a certain threshold, we're actually required to recalculate your debt-to-income ratio. And there are a number of times where the debt-to-income ratio is maybe right on that borderline between approved or not approved. And if there is a change in your credit balance that's significant enough, that can cause us to have to go back to the drawing board on that, and it can potentially cause a real problem. Next up, don't make any large deposits without notifying your loan officer. Now, this dovetails with what I mentioned before about having a clear plan for the assets that are going to be used for the closing. This is very, very important, and it's so important that I decided to put a separate line item here in the don't section. It may seem innocuous to make, you've come into 10 grand, somebody wrote you a check, you sold something. Making that deposit in the account will potentially trigger the lender to ask, where did that money come from? If it's an acceptable source of funds, there's going to be documentation required to validate that source of funds. If it's an unacceptable source of funds, that could potentially cause a problem depending on what your current asset balances are in the file. So just best practice, again, is don't make any large deposits without getting on the phone or through email with your loan officer. Next up, this one, I kind of hesitated to put it on there, but I think it's important. I don't want it to come across the wrong way. There is an unfortunate expectation that the loan process is going to make sense. And I actually don't have any problem with telling people just point blank. There are many times where the loan process, to somebody that's not in the industry, or even to somebody that is in the industry, there are many, many times where there are rules, there are guidelines, there are documentation requirements, et cetera, that don't make logical sense. A quick example that I can come up with is, let's say you have a lot of assets in the bank, but let's say maybe you just quit your job. This is actually a scenario that I ran into last year. Somebody just quit their job. They had enough money in the account to actually purchase the property in cash. and they presumed that on that basis that they'd be approvable for a loan. Well, the loan underwriting rules, especially under the regulatory environment where we're required as a lender to prove the borrower's ability to repay, you may think that the assets alone would qualify that person because they could clearly pay off the loan. It's unfortunately not the case. You've got to have income in order to qualify for a traditional loan, and that is a great category where, and I've even seen extreme examples where somebody's got millions of dollars in the bank, and maybe we can't get them approved for a standard loan for $400,000, and that's really silly that we can't do that. But the mortgage guidelines, again, they're not set by companies like my company, Paramount Bank. They're set by these large mortgage agencies, Fannie Mae, Freddie Mac, FHA. The rules aren't always logical. They don't always make sense. They're certainly not always fair. But what I view my job as the loan officer is to help you navigate that process, which sometimes has some aspects to it that are not super logical. And it's really my job to kind of shepherd you through that and to get around things. Where this really comes up most commonly, it relates to, say, requests that the underwriter makes for documentation or paperwork. I know that sometimes the documents that we request or the information that we ask for may trigger an eye roll or two. And I understand that. There are things that we ask for that seem ultra nitpicky. Oh, we need to know this land that you own in Idaho. We need to know what the taxes are for that. And that may seem really silly that we have to get that fine-tuned into the nitty-gritty of every little number, but it is unfortunately the rule set that we have to operate under. And there are many such cases of things that don't necessarily always make a lot of sense. And then finally, this is tended on a more positive note. Don't try to do everything yourself, particularly on a purchase transaction. I find it's the case that a lot of people don't lean on their realtor enough. And maybe they don't lean on their loan officer enough. You have, whether you're doing a refinance or a purchase, you've got professionals that are working for you. In the case of a realtor, the realtor's job is not just to open doors for you. They're not just a gatekeeper of information, especially in the internet age where all the real estate information is publicly available. It's the realtor's job to advocate for you. So when things get tough in your contract process, the classic example is home inspections. Home inspections are not good. You've got some things you need to negotiate for. It is the realtor's job to advocate for your interest in that, and you need to lean on them for that. Another example would be a case of, let's say, an appraisal comes in low on a purchase, which is something that just happened to one of my clients a couple weeks ago. That agent, in that case, that realtor, ended up being very proactive and helped out a lot. But it is sometimes the case that I find that clients are not leaning on the people that are supposed to be working for them. So don't be bashful. This is about your transaction. It's about your closing. Call me, call your realtor, call the title company. Make sure the people that you're paying fees to are earning their keep. Lean on them. It is our job to help throughout this crazy process that is getting a mortgage. If you have any questions for me, please do reach out to me anytime at the number in the description below. I look forward to talking with you. Thank you very much for watching this quick tip.